Hello, in this video we start talking about Chapter 2 for Principles of Accounting 1. So in Chapter 2, we're going to continue our discussion about financial statements that we ended Chapter 1 with. So financial statements are used as a way to report information about the company. And how we use the financial statements is for information purposes. So how well did we do at making money, bringing money into the company? How well did we do at controlling costs? How good did we do at managing our assets and our resources? And then external users use them to decide if we are a good investment, if they want to loan money to us, if they want to buy our stock, or how the company is performing as a whole. So we look at a lot of different things. We can also compare ourselves to other people within our industry. That's another word for that is called benchmarking, where we compare ourselves to people within our industry to see if we're similar or doing better than other companies. Okay. We use different financial ratios to analyze financial statements. So we'll learn some financial ratios along the way, generally 1 or 2 per chapter, but we do financial statement ratio analysis as the very last chapter in Principles of Accounting 2. And then you will also analyze financial statements as part of business finance, which you will take in your 2nd or 3rd year, or after Principles of Accounting 2. So the different sections of analysis are liquidity. What liquidity is our ability to pay our bills. So can we pay our bills over the next year? Solvency is the ability to pay over the long term. So not just can we pay our bills this year or this month, but do we have enough resources to pay off long-term debt and continue going as a business for years and years and years? Profitability, this is how much money we make. Are we able to make higher revenues than what our costs are? What is our net income compared to our expenses? And then market prospects looks at how well is our stock doing. Do we pay out dividends? Do we have growth potential? Are investments attracted to buying our stocks? So we have these financial statements that we introduced in Chapter 1, and now we're going to talk about them a little bit deeper than we talked in Chapter 1. So we have the statement of financial position, or the balance sheet, our income statement, and statement of cash flows. So the balance sheet is where our business sits on a very specific date. It is the accounting equation. It lists our assets, liabilities, and equity. And for our balance sheet to be in balance, assets have to equal liabilities plus equity. It is the financial statement is a representation of our accounting equation. So this is an example of a balance sheet with assets on one side and liabilities and owner's equity on the other side. Another way that a balance sheet or a statement of financial position can be made is with the liabilities and owner's equity underneath assets, so it's all in one line. They do not have to be side by side. It can be stacked all in one column. Then the income statement. Income statement is revenues and expenses for a period of time. This period of time can be a month or a quarter or a year. And it's the amount of money that we have made as part of the business, and then all of the expenses that we paid during that month. And then the net income, which is left over, is the difference between revenues and expenses. So an example of a very simple income statement, sales revenues minus expenses equals net income. The statement of cash flows talks about how we use cash. Where do we get cash from, and what do we use cash for? This explains the change in the cash balance on the balance sheet. So this statement says, why did the amount of cash we had change from one year to the other, or from 1 month to the other? So this is an example of a statement of cash flows. So we have cash flows from operating activities. Operating activities are those activities that are required for our business to run. So activities that happen every day. We pay expenses, we make money from revenues, we have accounts payable, accounts receivable, different ways that cash runs through those accounts. Cash flows from investing activities. Like normally when we think about investing, as a person, we're going to think about stock, because when we buy stock, we're investing in a company. However, when a company sells stock, it's a way to get money. So stock is a financing activity for a company. And investing activities are those purchases of long-term assets. When we buy land, when we buy buildings, we're investing money in assets for the company. So investing activities are associated with long-term assets, and financing activities are associated with stock dividends. Okay, now we're going to talk about assets, liabilities, and equity. And we're going to talk about them deeper. So we're going to talk about what are assets, liabilities, and equity accounts. And then further on, we're going to have even more depth into the asset accounts, the liability accounts, where we'll have 2 chapters on asset accounts, 2 chapters on liability accounts, and then a chapter on equity accounts. So one of the pieces of our accounting system is source documents. Source documents identify and describe the transactions that we are going to enter into an accounting system. And examples of source documents are receipts, bills, purchase orders, checks, payroll slips, bank statements. And then we have accounts. So we record accounting information into individual accounts. Cash is an account, accounts receivable is an account, accounts payable is an account. An account is just a record of what happens to a specific asset, liability, equity, revenue, or expense. A general ledger is all of our accounts together. So some companies have different accounts than other companies. All companies have cash. All companies have accounts receivable, accounts payable. Not all companies have service revenue. Some companies have merchandise revenue, which comes from selling inventory. Okay, so we have different examples of different accounts here in our accounting equations. We have asset accounts equal liability accounts plus equity accounts. So let's talk about asset accounts. So asset accounts are things that the company owns. Things that benefit the company, resources that the company uses as part of the business. Cash, buildings, equipment, supplies, land, and then accounts receivable and notes receivable are money that people owe to us. Accounts receivable, we've offered a good or service on credit and people are going to pay us cash later. In notes receivable, we've loaned money to someone. So we gave them a note, we loaned them money, and they owe us, they have to pay us back at some point. A prepaid account is where when we pay things in advance. So for example, if we paid for an entire year of insurance all at one time, then that's called prepaid insurance. We used the insurance 1 month at a time, but we paid it all in one chunk. We're going to talk a lot more about what happens with prepaid accounts in Chapter 3. So our assets are owned by the business, they're economic resources, and they are expected future benefit to the organization. So they're money that we can use to buy things, it's inventory that we can sell to make money, it's supplies that we're going to use in the day-to-day business, equipment and building that we're going to have our operations in, things that will benefit future operations. Next, we have liability accounts. Liability means that we owe someone else money. So we have accounts payable. We bought things on credit. We have notes payable. That means we took out a loan and we owe people money. Unearned revenue. What unearned revenue is if someone has paid us for a good or service and we have not given that to them yet. So we've been paid, but we haven't earned the revenue yet. One of the accounting rules says that we can't record revenue when we get paid. We can only record it when we earn it. So if we have undelivered goods and services, then we have unearned revenue. And accrued liabilities are liabilities that we need to pay, but we haven't paid yet. Things like when we record wages, but we're going to pay them a couple of days later. So liabilities, financial obligations is debt. We owe money to other people. We're going to have to pay cash out to those people. They're listed on the balance sheet in the order in which they are expected to be repaid. Okay, and then equity accounts. So equity accounts are our stock, dividends, revenues, and expenses. So these are our 4 types of equity accounts. We can have different kinds of stock, but we're going to get into that in a later chapter. So owner's equity, the owner's claims on the business, and shareholders' stock is owned by owners. So corporations have lots of owners. Okay. It says that the amount that we have priority. Now, if a company goes bankrupt, okay, if companies go bankrupt, then creditors get paid first and then the owners. So the owners get what's left after all of the liabilities are paid. Liabilities get paid first. But once the creditors have been paid in full, then the owners get whatever is left. Okay, so then we have our expanded accounting equation where we add common stock, dividends, revenues, and expenses as part of our equity account. Revenues and common stock increase equity, and expenses and dividends decrease equity. Okay. The general ledger, as you remember, is the collection of all accounts. A chart of accounts is a list of all accounts and a coded number that goes with the account. So this is a tracking system. So you can see in this example here, all asset accounts start with a 1. All liability accounts start with a 2. All stock accounts, regular equity accounts start with a 3. Revenue accounts start with a 4, and expenses start with 6. So this is a chart of accounts where we've listed all of our accounts with their coded number that's associated with them. Okay. And then this is an example of a ledger where we have all of the activity within an account. So you can see the top account is accounts receivable. We have all of the activity that has happened during a month and what the current balance is in the account. Okay, now we're going to save double entry accounting for the next video.